Hello, thank you for joining Evenco 13th installment of TrendWatch. Evenco runs award-winning European fund forums and data analytics for the fund selection community. Bloomberg Intelligence partnered with Evenco for this webinar, as well as in-person events where the panel discussions come to life, where the two fund forums coming up in early November, both in Milan and Lisbon. Make sure to check out the website to get involved in those events. Today, we're going to talk about the alternative presence in the portfolio allocation of balanced portfolios. My name is Paul Goldberg. I'm a senior analyst with Bloomberg Intelligence, covering financials and alternative asset managers. Let the panelists introduce themselves. Matthias, maybe we'll start with you.
Thank you, Paul. Happy to introduce myself. I'm Matthias Pfeiler, Head of Asset Allocation at LGT Capital Partners. We are an alternative asset manager with about 95 billion in assets, more than 20 years of history, and happy to share with you some of our thinking behind alternatives in a balanced portfolio.
Leo?
Sure, I'll go. My name is Leo Niesel. I'm a senior associate at Mercer Alternatives. We're a consultant and solutions provider, fund of funds manager in the alternative space with roughly 30 billion under management. So my focus is on infrastructure and particularly sustainable infrastructure.
And one.
Hi, good afternoon to everyone. I'm Juan Hernando. I'm the head of fund selection at Morabank in Andorra. Well, we have been traditionally more focused on the long-only side, and during the last 4 or 5 years, we have been increasing our capabilities in the liquid side, as we see that there's a big demand and there are a lot of opportunities for our clients.
Thank you very much, gentlemen, for the introduction. So let's start with the first, and I would say the really broad question. So how the rising rates, higher inflation, change in macro environments, obviously geopolitical risks in the environments that just can't come today in the last several years, how they change in the need to higher allocation for the alternatives and demand for those higher alternatives. We're talking about both private equity, private credit, other segments of the alternatives, other strategies in a more balanced bond and equity portfolio. And Juan, maybe we start with you.
Sure. Well, in general terms, we are positive. We are favorable to liquid assets in portfolios, especially for all those investors that can afford that. I mean, afford in the sense of liquidity, in the sense of all the premiums that are, all the constraints, the several capital costs. So not everyone is ready for that, and we have to admit it. But in terms of the investment, well, maybe the environment has changed in the last 2 or 3 years in terms of the interest rates, in terms of the inflation. I think that several of the tailwinds that usually have there used to be in the market, right now there are not anymore. I mean that I think maybe in terms of the activity, the peak was maybe 2 years ago in 2021. And right now, during the last 2 years, there are not so many activity. Of course, there are opportunities. I think that for the investors that still hold cash, well, there will be good opportunities. We'll see how the environment affects to the private equity in terms of valuation. We will see if there are so many investors interested in private debt. I think that there are some of the ideas, some of the investors looking for higher yields maybe 2 years ago that right now they don't need this to afford this liquidity. But in general terms, I will say that that we are positive. We are favorable to the liquid investment, to the private market. I think that is a big step. I know they are having a broader base of investors, but I think that maybe not everyone is ready for that, but the opportunities are still there.
Thank you, Juan. And Matthias, your perspective?
Yeah, I think I fully agree about the paradigm shift that has happened in the market. We are now looking at higher bond volatility, higher macro volatility in general. So that has that is putting the classic 60-40 portfolio under pressure. This shift towards a world that has been favorable to beta is now becoming a bit more complicated, simply because the cost is higher. The cost of interest, the cost of energy, the cost of labor. And so in this more complicated world, what we believe in is that a long-term time horizon, a long investment horizon, as well as alignment with companies such as the private equity ownership model is gaining importance, because you have to look through this macro volatility and see the opportunities. So very much agreeing to what Juan said, very favorable on the asset class, very bullish on the asset class in terms of the capability to generate alpha in this environment. There's also headwinds, like the higher rates obviously puts pressure on levered structures. And we believe that it's important in this market phase to be nimble and be able to offer a solution, be it in the form of private credit or secondary funds that can offer liquidity to those who need them. And Juan said it a couple of times, is not everybody can afford illiquidity. So we believe we look also to a market environment where provision of liquidity solutions is going to be rewarded. So I'll stop here. We'll maybe come back.
Perfect. Thank you, Matthias. And Leo, anything to add from your perspective as an allocator?
That was pretty comprehensive already from both of them. So I don't have too much to add. I think one thing, obviously rates is a topic, inflation is a topic, those are the obvious ones, and those depend on the different sub-asset classes within private markets. I think there's a lot of variables and a lot of differences there. But I think the main important thing is these kind of macro trends that have really been accelerated. You think about energy independency, you think about data, the acceleration of data use now with, there's the pandemic, and now there's AI applications. It's these kind of things that are really, I think, driving interest in private markets as well, because we're really uniquely placed to invest into new technologies here and new solutions, and really build from the ground up, right? Not just move existing capital, but really allocate new capital to the space.
Got it. Thank you, Leah. Before we move on to the next question, I just wanted to remind to everybody, if you want to ask the panelists a question, there is a Q&A box in your Zoom screen. Please input your questions in there, and we'll try to get to as many of them as we can throughout the conversation. So, Matthias, maybe we can come back to you. You mentioned the 60-40 portfolio. We had some research from KKR allocators, and I know these guys were suggesting the 40-30-30 portfolio. So you look at the broader landscape. So you have some endowments that have about 50% of their money in alternative, but you look at the retail and the investors, and that could be in like low single digits. So where is the kind of a right amount for which investor? How do you think about it?
Yeah, you mentioned KKR, and the paper is really worth reading. The argument they put forth is, how much can you, to maximize diversification benefits, how much would you allocate? And diversification is really coming from accessing the illiquidity premium. Now, in our simple answer, the magic number is 30-35 all in for us, but that assumes an investment horizon of 10 years plus, right? So it's really this more institutional setting that affords this, and many of our clients go along these numbers. We also have solutions where you just look at an illiquid piece to be added into an existing portfolio, in which case we often talk about a 10% up to 15% quota. And then in private wealth, it's yet again different. These numbers can be a lot lower because of liquidity needs. Maybe there's some provision to, provide capital. But I would stick to the magic number of 30% that I would propose which gives both sizable access as well as flexibility in the remainder of the portfolio. I should add one thing. There's also other alternatives, more liquid alternatives like hedge funds that can play a role in complementing the illiquid exposure. And that's important because maybe we will touch upon this later. When you manage closed-end funds, you will have capital calls, and you want to have a part of your portfolio without beta to be able to meet these capital calls. So it's really, this alternative space is really a bit broader than just the liquid. It also has some liquid portions that are necessary to make this number 30% work.
Got it. Thank you very much, Matthias. And maybe we can turn more to Leo in one you mentioned, and you can come back to expand on that if you wish. But you mentioned liquidity versus illiquidity. So Leo, maybe start with you. What kind of considerations you put up front when you making investments in terms of liquidity needs for the clients?
Yeah, I think Matthias really touched on it really well already. When you invest into a closed-end vehicle, there's going to be a period, an investment period for that fund where capital is drawn down. So say you make a 10 million allocation, where do you park those 10 million whilst the capital is being drawn down? I mean, it's a long time period, right? You can't just have it sitting in a bank account. Do you find a proxy, something that proxies the fund that you're investing in, or do you put it into something with no beta? I mean, there's huge considerations there. Then there's the drawdown period. Then you're getting yield back as well. At some point, that fund is going to start disinvesting some of its assets, and you're going to get capital back, which means that your NAV is going to start falling again. So you have to think, like, if you want to maintain a 10 million exposure over a long period of time, for example, you need an active capital program to keep on deploying that capital into new funds, into new investments. I think that's not easy for every investor to manage. That's a challenge. There's obviously open-end solutions. There's different kind of products here, but in the typical closed-end setting, it's not that straightforward. Yeah.
And Juan, maybe we can turn to you. You have both retail and I think wealth and institutional investors. So the differences maybe in considerations and how you think about it.
So, maybe we are more focused on the private banking, where we have a different approach. I think that in terms of liquidity, of course, we have to explain all the constraints to the investor. Sometimes they are not familiar with the several capital calls. So there are some solutions that maybe are more private banking oriented. That, for example, the only one capital call in several vehicles, for example, with the LTIPs. I'm aware that this is not the optimal solution, but it's not that bad in terms of operations. So it's a different approach, of course. It's not the institutional one, but it's a solution. And in terms of illiquidity, of course, we have to expect a premium for the clients, and I think that we have to explain that. Maybe there will not be a secondary market. Well, I mean, of course, there is a secondary market, but it's not like in the long only space when the client wants to redeem his money. But we have to be very very clear to our clients, to our investors, and to explain all the constraints. Of course, there's a great advantage in terms of potential returns, expected illiquidity premium, but there are important constraints that we have to explain to the clients and repeat. Not everyone is ready for having a 10-year investment.
Thank you, Juan. Maybe we can move to a kind of question that everybody would ask. If I'm putting money in alternatives, the two biggest considerations, what are diversification benefits I can get from a portfolio and by adding alternatives? And number one, and number two, what kind of a return enhancement can I possibly get going through the cycle? As you mentioned, Matthias, 10-year time horizons in many cases. So maybe we can come back to you and just everybody can chime in on those considerations when you put clients' money into alternatives.
Yeah, happy. I think again, just to answer with one number, it's something like 4% is the premium that you typically realize. That can be up to 8% if you're in a more growth-oriented style, like venture or growth-oriented equities. And I'm really talking about a 10 to 15-year time horizon over which this materializes. Right now, of course, I think it's important also to acknowledge that other asset classes, like the ones we briefly touched upon earlier, like credit and secondaries, look particularly attractive because they offer a solution to the market. It's always good. It's always a good idea to, offer liquidity when everybody else seeks it. And the heydays of commitments in the 2021, 2022, rather the 2020 and 2021, they will leave some investors with some gaps. And so all of this is the source of this premium, being able to hedge liquidity concerns that the market has. Now, the nice thing about this premium is it is not, it's a bit anti-cyclical, actually. It doesn't depend necessarily, unless you go to market extremes, on markets performing or booming, right? In fact, we observe higher illiquidity premium when the market is so-so, like sideways, but not blowing up. So this more like, kind of like the phase we're looking at right now. We are trying to solve a problem, which is the high cost. And we do see growth, but maybe it's concentrated in areas like digital and tech. The market is really searching for a path forward, and we might have setbacks in the public markets. That's when private excels, in our opinion, and that's then the diversification you want. So I'll stop here because Leo and Juan might also have their views on.
Yeah, absolutely.
So I think that diversification is one of the main points in order to look for an investment in an alternative in liquid assets. And of course, I think that we have to diversify not only by asset class, but as well for different years, for different vintages. For example, sometimes when we check the historical figures, we can see that very bad years in terms of macro or in terms of public markets later were not that bad in order to create portfolios. So sometimes for us it's not easy to identify when is the best entry point. So it's not a bad option to construct portfolio in several different years, so you can have exposure to different vintages. For example, in terms of private equity, in terms of private debt, of course, well, we can see that right now if we are creating portfolios, well, there's a very interesting yield for the portfolios, especially if we compare that to 2-3 years ago with the public markets, right? And obviously there are other options, for example, real assets, or maybe real estate can be a little bit difficult today because of the interest rates, but infrastructures are always another option. So I think that we have to diversify. That's the main idea when we make broad portfolios. And well, we can diversify not only because of asset classes, but if we are doing an illiquid portfolio, or if we're investing in this kind of assets, maybe diversify in terms of entry points. Several different years can be good as well.
Yeah.
I have nothing to add. I think they both covered it well.
Yeah, well, really well covered. I agree with you.
Can I add one more thing, because Juan made a very good point, important point, and I think it's also coming back to something we discussed. Diversification over vintage years is actually super important. It's one of the core disciplines one should have, and I see some questions coming into how to do due diligence and so on. So one thing is to stay the course when committing to the private market. That has the benefit over years that something Leo mentioned before, that you can fund some of the capital calls with distributions coming from older vintages. Plus, you can have the full range of sector exposures that can vary quite dramatically as you look over vintages, simply because the asset class is very nimble in identifying opportunities. So I just wanted to add that point. Vintage diversification is a key consideration. But I see the Q&As filling up. Shall we?
Yeah, we can jump into Q&A, because some of those questions, I think, and we can go through some of the things from Q&A and then come back to our discussion. One of the questions: what is the most important part of your due diligence process in private equity? So, Leo, maybe you want to start on this one?
Yeah, it depends what kind of investment you're looking at. So if you're looking at a private equity fund, our focus is typically on the teams. I mean, who are the people investing the funds, right? What are their backgrounds? What track records do they have? Are they coming from like an operating background? Are they coming from a financial background? How many junior team members do they have as support? Have there been recent departures and leavers or newcomers to the platform? That's one element. The other element is the alignment with investors. So are these managers investing into their own funds? Are they putting their own capital to work? It's obviously not a good sign if a manager is raising a fund. They say it's the best fund that they've ever raised, and they don't invest their own capital into the fund. We don't like to see that. Are the management fees outsized? What is the carried interest structure like? Is everyone in the firm profiting? We look at the strategies that they follow. Are they really doing something unique? How are they creating value at a portfolio company level? Are they just buying, let's say, a wind park, and then they just hold that wind park forever? I mean, that's not adding value. What operational improvements can they add to that wind park? Can they add development elements, for example, grow that wind park, or conduct M&A to add to that portfolio? And then obviously a key part is the track record. I mean, what is the team that you're investing into achieved in the past? What returns have they done? Have they delivered on their promises? That's if you're looking at a fund. If you're looking at a co-investment or a GP-led secondary, which are basically single asset deals, obviously it's a very different game, where you're really analyzing the underlying company. What are they doing? What tailwinds are there? Was the management team there like? It's a very different discussion, I think.
Well, in my opinion, I would say that the most important thing is getting to know the team and getting to know who is behind all the idea. Well, if you compare it to the traditional only due diligence, maybe one of the most interesting difference would be the data access. I mean, of course, there are databases in the private equity or in the private markets, but it's not so, I would say, easy. It's not so easy as it is in the public market. I mean, there are different ways to find it. And another interesting thing, well, from my point of view, is that a lot of new entrants in the industry. I think that maybe Matthias has been working, and Leonard, they have been working a lot of time, and they can realize that there are a lot of new teams. I would say a lot of people that traditional asset managers that say, no, right now we have like our illiquid asset arm, and well, they come from KKR or whatever. But I think that it's interesting, and for the people like Leonard and Matthias, well, they can see this phase, or this evolution. Some teams that they used to know from their previous experience in the liquid side, and right now they are working trying to replicate the model, but in a company that traditionally was a long-only side. But just to make it short, I would say that well, the most important thing is always I think that this is a people's business, and it's very important to get to know the teams, and just to realize if they have the means in order to make this job.
Sorry, was muted for a second. And Matthias, just to come back to you, and I know maybe we can throw into that conversation also to your due diligence and everything else, like whether the views, when is it preferable to work with a larger manager, a smaller manager, and if you guys want to come back to kind of that conversation, we can, but maybe we can add something of that nature to the question.
Absolutely, yeah. I mean, the question, large versus small, allow me to answer it from a company level and say small is beautiful in many respects. Small companies, you can grow faster, you can bring what Leo said, value creation drivers, you can look at the cost structure, you can really have low-hanging fruits and bring the company up to speed, plus realize profitable exit by selling it to a larger company who sees it as a strategic asset. In addition, you have typically less leverage. What you see at the moment is a lot of the larger GPs also coming to the small and mid-market space where we are generally active, simply because they are easier to finance. These are smaller tickets. There's less leverage involved. And of course, that's one of the key concerns right now. So we like niche. We like this, these areas where we believe there's a lot of potential for alpha to bring your skill to have the greatest impact from it. That said, for an investor that's only getting started with the asset class, a large diversified portfolio, including some large buyouts and potentially even mega caps, can make sense. Just to be exposed to all areas of the market.
Yeah, I would add to what Matthias said there. I think when you're building a portfolio, you want to have a base to build on, a manager covering probably all sectors or regions. So you can get one manager that covers North America, or a global manager, a European manager, and then different risk return profiles. But then it's really nice to complement it with these small niche specialists. So I mentioned renewables already, but there's so many different elements of the value chain where you can create value. You can go into development, you can go into construction, into operations, into repowering, and you can select these really niche managers that have specialized teams that have been doing this for 15, 20 years, and there it makes sense. I think the other two areas where it makes sense to go with a really specialized manager, or even a co-investment, for example, if it's like a trophy asset, you think this is one of the strongest assets or managers out there in this niche space, so you go for that manager. Or if you want to create specific impact in a specific area, if that's your focus as an investor, to create impact, you can have specialist green data center manager, for example, or a renewables manager, or a sustainable transport manager to your portfolio, which typically makes sense if they're niche and specialized and small.
Sure, I think that the niche specialist, well, it's great from the point of view that they can get to know all the dynamics, all the people. They can establish long-term relationships that for sure they add value in this business. But if you have to, it depends on the percentage that you can allocate into these funds. If you don't have a big percentage to allocate, maybe it's easier to use a broader approach and to use a generalist fund, because maybe you can choose a wonderful fund within its sector, but if that sector doesn't work, maybe you can have a cost of opportunity. So if we don't have a high percentage, we would use a generalist fund, and if we have more opportunities, obviously we could use more satellite or more niche managers.
Thank you, Juan. So let's switch to the infrastructure investments. It's a $1.2 trillion alternative market out there. What's so attractive about the space? What a consideration? I think there are some questions in the chat that touch upon that, so maybe we can lever off those questions as well. Leo, I know it's your area of expertise, so maybe you can start, and we can sort of go through the chat questions as well as we focus on that space.
I'll try to cover the question in the chat on stable infrastructure in the same answer.
Sure.
So I think there's three main reasons, I would say. The first is there's like these big structural mega trends, right? And infrastructure is perfectly placed, and they've been accelerated by COVID, by the Ukraine crisis and everything. And that's obviously energy. There's the generation part, but then there's the whole intermittency challenge. How do you get the electricity from A to B over large areas of land? That's one element. Then there's mobility. I think there's a big push to create sustainable mobility solutions, whether it's EV charging, but I think you have to look beyond that and go into sustainable shipping, for example, as well. Like, how do we make container ships more green? Then there's just a general trend to more people moving into cities, right? And that infrastructure, there's aging, but you also need new infrastructure to cope with the new demands of society. And then finally, there's data infrastructure, which is just a topic that keeps on accelerating, especially now due to the artificial intelligence points as well. But there's a data center question, but maybe that's a separate question to take. So it's one of those mega trends. Then it's obviously inflation and interest rates, which infrastructure is just really well placed to take advantage of. But I think that's, again, a whole different discussion here. So I think it's really those two main things. And then it's the value add, right? I think investors are increasingly seeing, if you buy a stock, you're just shifting money in public markets. You're really just buying a position off another investor. But if you're investing in private markets and infrastructure, there's really opportunities to add value by building platforms, by through M&A, through organic growth, through new areas, new regions that you can enter with this company when you actually own it and can operate it. And I think the combination of those factors just makes infrastructure a really exciting space to be invested in. And I think investors are now taking increasing advantage of that.
Yeah, Matthias, on your end?
Yeah, absolutely. It's part of the new paradigm that we mentioned earlier. There's going to be a lot of fiscal support as well, to make maybe lessons learned from the pandemic and the geopolitical situation. We need to invest. We've been underinvesting in infrastructure, and our security, supply chain security, national security, data security. So there's all these areas that Leo mentioned that support the theme, and obviously an asset class like private infrastructure is well positioned to play these. Also because you need to have a longer investment horizon. These things don't build themselves overnight. So it makes complete sense to align yourself as an investor with this grand theme. And I think it's also, it's a piece in the puzzle. There's one question in the chat that asks, is that going to affect my ability to generate alpha? I would say it's the contrary. It's the making stuff cleaner and greener is an innovative activity that unlocks new growth potential. And one of the ways of making ourselves greener is to be more productive, less oil per ton of output. And it's already happening with the seismic shift of our economies towards service-led value add. So I think it's going to continue, and to have the right capital in these places makes a lot of sense.
If we can maybe put those questions in sequence and think about the infrastructure, the sustainable investments, and then take it to the manager level. What are considerations that you guys give in your manager selection, in your due diligence process, when you're really trying to distinguish who are the real investors in the infrastructure, where you really put in the money?
Yeah, I think we kind of touched on it before. typically, you know, the good managers are those that can add value. And I'm not talking about just selecting the good companies, but it's about operating those companies. And you can see that from their track records. You can quickly get a feel from the track record, obviously, but also when you meet them, you can quickly see, are these intelligent people? Do they work well together? Is it a well-gelled team, a well-staffed team? And it's the ones that really have credible, believable strategies. I mean, there's some managers that we speak to that, you know, are in data infrastructure, for example, and they speak about nothing else there. You can tell they're so devoted to this one topic, and that catches you as well, right? You can tell that they know everything about this, and those are the kind of people that I think you want to invest with. People that kind of, you meet them and they inspire you.
All right, thank you, Leo. So you guys mentioned secondaries a few times during the conversation. So with a lot of backup and realizations in the space, the slower deal environment, slower exits, what are the considerations and what are the attractiveness of the secondaries? Matthias, maybe we can start with you.
Yeah, we've been in secondary markets for a very long time. Our experience is whenever there's good assets but forced sellers because they probably own too much, it's Goldilocks, of course, to be in a secondary fund and pick up these opportunities. Now, this is slowly trickling in, and why is it only happening slowly this time around? Well, one of the things is that we've had an extraordinary monetary expansion, a decade of it, with a raise then during COVID. And there's still a huge pile of capital sitting as dry powder, supporting valuations. So these huge markdowns haven't materialized yet, but in our view, this is going to start to bite. It's just taking longer because of this, you know, stock that delays the process. So that said, secondaries are also interesting per se, in that you're buying into more mature assets, maybe assets you know from the primary side, or from, you know, the manager of these assets. And you provide, as we said before, a solution to someone seeking liquidity, having the benefit of you know, less risk and more transparency when you look at a secondary fund. Of course, you need to have the tools. Juan mentions databases. It's not just like easy data. It's data you would preferably, you know it from previous investments, to be able to you know, make a good decision. But in general, it's also very interesting per se. And then there's secondary on fund level, but also direct secondaries where you buy assets. And that's something Leo mentioned before. That's a more difficult, but also very interesting play or game, in which you just do your due diligence level. But you have to have the experience of, you know, understanding business plans, understanding perspectives, and then be able to come up with a fair price. So the element of at what price do I buy into such portfolios or companies is of paramount importance in that space. And it's good to team up with experienced people that have seen deals in the past, so you can, you know, unlike public markets, you don't have a majority benchmark or something. You really have to look at it and come up with your own fair value.
Yeah, Juan, do you want to weigh in on that? And
sure. Well, I think that secondaries can be a good opportunity in this environment. Why? I would say that there are some clients, there are some investors or LPs that want to make an exit, want to realize some profits, and well, this is a different market. So if you have money, if you have cash, well, you can get good opportunities. Maybe I think that if we continue in the higher for longer environment, it can be better. I mean, better for the investors with dry powder, because they can get better opportunities. If in this is the same when it comes to the recession, well, it can give good access to the buyers. Maybe some sellers are trying to realize profits, but I don't know, they are expecting for a good price, and that could be that could be a good point for the secondaries specialist. And I think that in general terms, secondaries can be a good option, not only for that, because there are good opportunities, but if you want to create a portfolio, somehow it can help you in order to reduce the J curve. That is something that maybe we didn't explain, but for some private banking clients, they don't accept it easily. So if you can reduce the J curve, I think that secondaries can be a good idea. Well, it's a bit better for them.
What I would touch upon again is the GP secondary space as well. So GP secondary, I mean, typically in the past, it was a manager held a company that they really liked, but the fund was at the end of its life cycle, and they thought there was more value to add to this company, and so they sold it to their own investors, or part of it at least, and created a continuation fund, a new vehicle that only held the single asset. And those are the best assets, and you could blindly almost invest into these GP secondaries because they're the best ones. But increasingly, I think it's seen as a way for GPs to also get liquidity for not their trophy assets, but also the assets that they simply just can't sell. And this has meant that the whole market has really exploded in size, and you really now have to do really specialist due diligence on every fund, on every secondary, GP-led secondary that you see. You can't blindly trust the GP anymore. It doesn't work. I think that's a challenge now for LPs.
Thank you, Leo. One of the questions in the chat that was asking, how do you assess the liquidity risk in the primary market versus in the secondary market? Anybody can weigh in on that?
Well, maybe just quickly, and happy to. Well, as I said before, secondaries are more advanced in the J curve. So just from that perspective, you have the capacity to, look through and understand the assets or the portfolios. I would clearly say that's a less risky position to take. I mean, the sooner you are on the J curve, the higher the variance at the end. If you've already some part of it behind you, as quite often in this GP lands, then you kind of know what it's a lower risk bet. So that's a short answer. Of course, it's all conditioned on your ability to understand the assets. Otherwise, yeah, it's I mean, in the end, it's legacy positions, right? You take over. You want to understand them well before doing that.
Thank you, Matthias. So maybe switch to geographic considerations. So when you pick funds, investments, do you look for something globally? Do you look for something that's more geographically focused for different kinds of specific funds?
Shall I take it? Okay.
Yeah.
I think speaking for us as an organization, we're very opportunistic. I think if we see a good investment in a certain market, we'll typically look at it. And I think it's not so easy to apply one thinking to one market. Some investments could be good in one market, they could be poor in another market, and vice versa. It really depends on the sector that you're investing in. It becomes tricky when you're investing in South America and in Asia, for example, because you end up taking significant currency risk at the underlying company level. These are companies that then operate, for example, in Brazil. They could generate a really nice return in Brazilian real, but then when you convert it back to US dollars, it becomes tricky because your return just typically decreases significantly. And so I think investors are still really focusing on North America and Europe in general. I think the demand for those investments in emerging markets in South America and Asia is picking up, but it's definitely not getting near to the level that we see for Europe and North America.
So I agree. I think that it's very complicated to find clients focus on these emerging markets, especially South America, especially Asia, and it's more useful for us to offer opportunities, to offer funds focusing on Europe mainly, and to a lesser extent to the US. But at the moment, I don't think that there's a big appetite for emerging markets in this area.
Thanks, Juan. So
Agree. Yeah.
Yeah, go ahead, Matthias.
Well, just to add that Europe is indeed, maybe unlike public markets, it's a very interesting space, very dynamic companies on privately owned or PE backed. And then on emerging markets, Asia, and that's not only China, that's really broader Asia, has typically been a very strong growth story, obviously, and it continues to be. Maybe less in China for because there's a bit of a debt deflation going on, but there's plenty of interesting places. And good thing about some of the Asian currencies, at least local dollar is very close to, so the currency risk can be handled in a at least marginally better way than for South America. Just two additional notes. Yeah.
I'd add one thing there as well, if I can come with another topic there. I think one thing is, especially in Asia, what you need is really local teams, like hyper-local teams. If you're investing in India, for example, it's such a specific market. So you need you need a local team of local people that have been investing there for a long time. And that's not necessarily easy to find. I think some of the global players have been burnt in some of these countries by coming in with teams from Europe and then finding, oh, this is actually a very different space. We can't allocate the capital, or can't get around the local customs and regulations in a way that we thought we would.
Yeah, thanks, Leo. I do see it from a lot of the large managers that I cover, like KKRs, Blackstones, that they are opening up offices in India, actually, and hopefully they're doing the right thing and getting the local people on the ground. So let's turn more to the chat, to more questions in the chat. I think one of the questions is very specific to I would guess private credit. It's somebody's asking if the current market environment of upward pressure on bond yields strongly affecting prices, what type of private investments could provide bond-like yields? I would throw out private credit there, but I'm sure you guys have a lot more insight in the different categories and variation within it. So, Matthias, if you want to start.
Yeah. I think the answer is broadly private credit, and of course benefits being it comes without the duration risk. It's a LIBOR plus in most cases, but then within private credit is an extraordinary number of shades and formats. What we like is a portion in direct lending, and that's really unitranche lending, not just senior. Across the board, like again, this idea of providing solutions to companies. But we also like CLOs being, the workhorse for anything that private equity does. We also look at distressed opportunities when they arise, same idea, but obviously much more complicated to implement. But the one thing to say about credit, it's an extraordinary rich landscape of formats, and I think that means diversification. You can have certain project finances, for example. You can do that in sectors that are less cyclical than maybe on your private equity side. So we really look at it, from a portfolio perspective to where can we add most value. But yes, the answer is credit, clearly. If you look for bond replacement, right?
Right. Juan, anything?
There's one more area, if I may, and that is, a bit more liquid than the classic private credit, and that is insurance linked. Very interesting space at the moment. Like natural catastrophe risk, like reinsurance. It's interesting because the market is paying a very high premium at the moment. Partly because people find yield elsewhere, so there's less capital around. Plus, it's rather uncorrelated to anything that's going on in the financial markets. It's linked to events and claims resulting from these events, and otherwise just a stable compounder, very much like a bond that you hold to maturity. Of course, there's losses in which case it's different than a government security, but there's very attractive yields to compensate you for the risk.
Thanks, Matthias. Juan, you're starting to say, and you have a private bank perspective, obviously.
Sure, no, I think that private debt is attractive according to the yields, but maybe we would rather the senior tranches, because maybe we think that the defaults can increase in the following years, so it can damage the returns of the asset category. So of course there are great opportunities in distress in other segments of the private debt, but we would prefer the senior tranches, having into account everything, but we think that the default rate is out there and it can increase in the following years.
Thanks, Juan. Something that's been asked in the chat on the retail demand and from sophisticated investors, and I think it might even go back to you, Juan, if you have any kind of take from a private bank perspective. People are asking about the education piece of it. Blackstone has its own Blackstone University out there. They educate the advisors and on and on and on. So where do you see the demand and what you provide for?
Well, I think that the so-called process of democratization, well, I think that maybe it began 4 or 5 years ago, I would say. And what it was interesting, by those days, the bonds were, I would say, like 0 interest rates. So, for example, private debt, they offered higher yields, or they offered diversification. So they were very, very attractive. So there's this kind of demand, right? On the other hand, maybe some clients and investors, they like the way of support entrepreneurs. Maybe it's like, to have the access to companies different to the typical S&P 500 or the typical companies in the Euro Stoxx 50. So there was this kind of approach. But yeah, I would say that obviously it's not totally mainstream at the moment, but I think that the more sophisticated private banking clients are having access to the liquid markets, but on a slow pace, I would say. It's not like that right now we are not in the 50% of the endowments or the 30% that would make sense for insurers, but I think that they are going slowly, but they are having access to the liquid assets, and there's a demand. It's not like I would say like a banking forcing or offering that, but we have the demand from the clients.
Thanks, Juan. So we're coming close to our times. I think there are 2 questions in the chat that we can combine, and you guys can think of answering either one of them. One of them, how do you enter in the liquid space in a risk-averse way? And the other one that I think kind of floats with it, what type of investment funds do you avoid in the space? So they kind of both risk-averse questions. Leo, if you want to chime in on that?
Yeah, I'll take what funds do we avoid. It's tricky to answer. I think it's ones that have unproven technology, that are really taking these kind of 1 to 100 bets. We don't like those. We don't like teams that are unproven, that don't have any, visible experience that they can demonstrate. We don't like funds that have really poor track records. I think that roughly summarizes it. And then, I had to answer earlier, what do we like? What do we look at? And I think it's basically the opposite of that, And how do you enter in a risk averse way? I think, you invest over time, over a long time horizon. You make sure you have a lot of positions in your portfolio. Selecting one fund, for example, in the infrastructure space, you'll get access to 10 underlying portfolio companies. It's not a lot. So I think diversification is really, really an important way to decrease risk here.
So I would say the how do you enter the space in the risk adverse way? I would mention something like that Juan said. I would look into semi-liquid funds, like fully paid up vehicles, and just start gaining your own experience. Right? There's now vehicles that are not closed-end. You just invest and they even have some liquidity options. So you just enter small pieces and you gain. And the good thing about these vehicles, you get access to a fully diversified portfolio, like over vintages. It's not like, it's what we said before. If you enter that space, you don't want to have a bullet exposure in the 2023 vintage. You want to own maybe a full decade worth of vintages at various stages to diversify your risk, J-curve risk, but also cyclical risk pertaining to sectors that did well or not so well in particular market phases.
Thank you. So we close to time. If you guys want to take maybe 30 seconds or so for any kind of closing remarks. So Juan, we want to start with you.
Sure. Well, just to conclude, I would say that we are favorable to the liquid assets, but we have to be conscious that the new environment in terms of interest rates and inflation can change a little bit the field where we are playing. So we have to take this into account as well.
Leo?
Yeah, no, I think private markets belong in every portfolio. I naturally have a bias towards infrastructure. I like the space from a sustainability perspective and the trends. But I think adding any different strategy to your portfolio will help with diversification, with better returns over the long run. So I think it's something every investor should consider.
Yes.
Yeah, I fully agree with that. And maybe closing with an observation that private markets as an asset class has also grown, but it's still only 10% of public market cap. So it's still niche. But it's more mature, and it will play a significant role in transforming our economies, especially towards greener, more sustainable value creation.
Thank you, gentlemen. I really want to thank you for your time and your insights. It was really helpful and insightful for people to learn about the opportunities and potential for the alternative investments